Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. We're going to take a look at the shorter term time frame in this episode. Throughout the past couple of weeks, we've discussed the fact that we generally have a bullish outlook on the S&P 500. We're seeing signs of economic strength. We have high inflation, easy monetary policy. That's a generally bullish environment for the stock market. But here we're going to discuss the shorter term picture. Now we have this bullish bias on the markets right now in the current monetary environment, but we don't want our members and subscribers to be oblivious to the fact that this is a high risk market. Long term, we're overextended, and there's a lot of leverage in the market here. I wanted to show you this chart from Real Investment Advice that shows you the margin debt over time. That's of course at all-time high. Now that's not the big problem here. The big problem is that the free cash balance is crashing down. So there's a lot of debt. That's not necessarily a bad thing. Where you do start to encounter some problems is when you have a very low ability to service that debt. And you can see that is a development that we've seen ever since the March bottom here. We've had a tremendous rise in the margin debt and a dramatic drop in the free cash balance. So I do think that once we eventually see the market top, and I do think it's going to top once monetary tightening begins to create a downturn, you are going to see a bear market, and it's very likely to unwind very quickly. But in the meantime, all of this leverage is working in our favor, right? You do not want to be against this move. High leverage in a strong economic environment and easy monetary policy is going to fuel some wild moves over the next few months. If you're interested in following that with us, make sure to smash that subscribe button. And now without further ado, let's get right into it. All right, so I want to quickly begin by taking a look at this short-term picture, just the technical side of things. Now, just a couple of weeks ago here, I've put the RSI on this chart. This is a daily chart of the S&P 500. If you were watching our videos back here, we discussed this RSI reading and said that this was a short-term bearish signal that tends to correspond to local tops in the market. It does seem like that has occurred right now. It was probably not the best area to be entering into the market here at resistance, at this channel resistance. And as we had this overextension reading, the highest overextension reading since this area here in August 2020, leading up to that nice blow off top here. You've got the RSI here telling us that there's something wrong with what's happening here. You've got price near resistance and making a higher high. You can see this is a higher high on the price on the S&P 500, while the RSI here is telling us that momentum is slowing down. Right, that's divergence, that's momentum divergence, and it often corresponds to peaks. Let's take a look at previous moments where you had this type of divergence. You had divergence here on this grind up. Looks a lot like what we're seeing now. Price making slight higher highs, momentum coming down. That's bearish, triggered a nice correction. You had a similar thing happen right here. Price making a higher high, momentum coming down. That triggered a correction. And even here, you had price making a significant higher high, and the RSI just could not keep up and made a lower high. Triggered a nice September correction here. So if you were with us a few weeks ago, we were discussing this divergence, right, where we had price making a lower low and the RSI making a higher low. That was bullish, and that set up the stage for this nice rally. Now we're seeing the opposite happen. Could that mean we'll be consolidating a little bit more, maybe having a nice correction back down here? That's very possible. Now keep in mind that these divergences can extend. You can have a higher high, another lower high on the RSI before you eventually see that unwind. All right, so don't be surprised if by the time that I post this video, we're actually heading higher, building those divergences. Now I want to take a look at another chart here, a very interesting chart, the SPY liquidity premium. right? So this is a very interesting indicator to look at because it's a measure of fear. It's a measure of how much investors are seeking protection and seeking liquidity, right? If this is going up a lot, if this SPY liquidity premium indicator is going up massively, it's telling you that investors are seeking more liquid versions of their stocks. So they're exiting their 401ks and going into ETFs so that they can easily liquidate their position if things start to go sideways. So this oscillator here is giving you a measure of the fear in the market. We were looking at it back here in October. We had this spike in the liquidity premium. We had a lot of fear. But now look at what's happening. We have this indicator at the lower end of the range telling us we're actually now in a complacent market. We've gone straight from a very fearful market back in October, the end of September and October, and straight to a complacent market over the past couple of weeks here. Now, again, we can take a look at, how did the market behave in previous instances where you had this type of development, and you can see the risk reward is nowhere as favorable in these zones here, and you can see every single time it corresponds to a local top. Now, it's not perfect. No indicator is perfectly going to time every bottom and every top, but look at this. This bottom triggered a nice correction. This bottom triggered a nice correction. Then this one eventually led to this round top and September correction. Right here, you had another bottom, triggered a nice correction. So is this time going to be different? I guess we'll have to see. That's absolutely not guaranteed. But the one thing that's guaranteed is that the risk reward for entering long in the market, because that's what we're doing, right? We're trying to take advantage of this big move up we have on the S&P 500. We're trying to take advantage of all this leverage, take advantage of the inflation, the easy money. So we're looking for long positions, but we want to do that in the best way possible. And this is how the markets behave, right? This is trading. This is how you can be successful in the market, by identifying a longer term trend, identifying the macro strategy. Is the market going up? Are we in a bull run? Can we expect further highs in the market? And then looking to objectively position to take advantage of that trend. That's exactly what we do on these videos, and it's exactly what we do with our members at gameoftrades.net. We don't do day trading, scalp trading. There's so many terms and different categories of trading you have online. What we do cannot be found anywhere else on the internet. We've developed our own strategy to navigate the market that's based on our understanding of the market, our understanding of the macro environment, and technical analysis to objectively position on all of these opportunities, right? Trading should feel like you're skiing. It's extremely dynamic. You have to be able to adapt your position, and you always have to be looking for the next play. There's a lot of sector rotation in the market, and this is where we can actually beat the markets, by being in the right sectors at the right moments. If you're interested in learning about this strategy and finding out about our convictions when we're bullish on certain sectors, when we're not bullish on certain sectors, make sure to test out our free trial. You can test out the service completely for free. I do think that it provides a tremendous value. Now, speaking of sector rotation, let's take a look at the NASDAQ 100. The NASDAQ 100 has been the big leader throughout the past couple of weeks. This is a chart of the technology sector. And so you can see the incredible run up we've had since that low here. But now what's happening here is that we've had this major run, and look at this recent move here. We saw the NASDAQ attempt to move above the price channel, but it failed. And you have this bearish engulfing candle now, and a false breakout. So that's a bearish technical picture, and it could make the market leader that was a market leader become an underperformer and actually drag down the markets. So the technology sector is definitely not our favorite sector looking out the next few weeks. Now, going back to this chart of the S&P 500, I wanted to take a look at one more very interesting development that we've been looking at over the past couple of weeks, and that is with the VIX. Right, so let's take a look at the VIX first, and you can see what's been happening here. It's been rising steadily and stair-stepping up throughout the past couple of weeks. But meanwhile, the S&P 500 has been grinding up, making a higher high. right? So what does that mean when you have the VIX, which tends to be inversely correlated to the S&P 500? For once, it's actually been positively correlated. So what does that mean, right? Because usually when you have a spike in the volatility like we're seeing right now, it tends to correspond to quite a significant correction, quite a panic type of drop. That's what typically happens when you have volatility spikes. But that's not what we're seeing right now. We're seeing the VIX spike, but the S&P 500 actually made a higher high, and it's just been grinding sideways. So I'm going to put an indicator on this chart that's going to tell us how positively or inversely correlated the VIX is to the S&P 500 and whether anything has changed right now. And you can see what this indicator is showing us. It's showing us that the majority of the time, the VIX and the S&P 500 are inversely correlated. When this is below the zero line, it means it's inversely correlated. When it's above, it's positively correlated. So the majority of the time, it's below the zero line. But you can see here, we have a positive correlation. And you can see we had a very similar development right here in December 2020 and in September 2020 here. So this here has only happened 3 times. In this case, it eventually led to a correction. In this case, it didn't lead to a correction, right? So this is a bad data point. And in September 2020, it led to a sizable correction as well. So from a theoretical standpoint, you do not want to see this happen. You don't want to see volatility rise with the S&P 500. That's not particularly healthy, and it often foreshadows a correction. Now, it doesn't happen every time. Look at this. It didn't happen here, but it often does. So that's, I think, a great conclusion to the video. You can't give 100% certainty on anything, but the current technical posture, the current market internals are suggesting that we're likely to see a little bit more downside over the next few weeks. Now, that doesn't mean we're going to be shorting anything, but it means that you can have buy orders lower to take advantage of a potential move down in this massive uptrend that we're seeing. I hope you guys enjoyed this video. If you did, make sure to smash that like button. Now, in the meantime, I wish you good luck on your trading and see you next time.